The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
When it comes to following the money, it's easier to follow the crypto trail than the dollar trail, according to Gartner Research cybersecurity expert Avivah Litan, who argues that criminals can run but not hide in transparent cryptocurrency networks. Joining us now is Avivah. Welcome, Avivah. Thanks for joining us. You have an article out on CoinDesk.com. Criminals still find it easier to hide in fiat than crypto. Tell us what you found.
Well, if you look at cryptocurrency networks, they're completely transparent. There's 23 blockchains that constitute about 90% of the market cap. And if you're a fraud detection company, you only have to go to 23 systems and follow the money trail. If you're looking at fiat currency, you have to go to thousands of isolated systems from payment processors, banks, enterprises, and try to figure out how to look at the patterns across all these siloed systems across the world. So the truth is that it's much easier to follow the money trail on blockchain than it is going through the spaghetti code of banking and payment networks.
So, Avivah, this is good news, obviously, for law enforcement. But I mean, just looking at it from the perspective of the average retail trader, the average consumer, say they're buying Bitcoin through an exchange and maybe transferring it later to a wallet. Do they have any privacy protection at all? Because like the flip side of this is like cryptocurrency is supposed to have increased privacy relative to cash. But like, is that even true?
Privacy is not really existent on the blockchain either. Supposedly your name is separate from your address. If you're going through a cryptocurrency exchange, you have to have your name subpoenaed, your PII subpoenaed. But there's already all these darknet information sources that are combining addresses with other bank account, password, email address, mobile number. So you may notice that consumers that use centralized exchanges are increasingly getting hacked because all their data is there for sale, just like it's been for decades. Now the criminals just had to add the blockchain address to the data store. So the notion of privacy is not correct, actually. You actually have less privacy. And now there are some privacy protocols that are trying to mitigate that, make you more anonymous. But in the end, you'd have to hide the blockchain address. And you can't hide the blockchain address unless you go through some centralized party that's going to do that for you. So this notion of privacy doesn't really exist in reality. Now, that doesn't mean that yeah, go ahead, sorry.
No, go ahead.
That doesn't mean that the criminals have an easier time in blockchain than they do in fiat networks. I mean, the criminals can steal data in any of these systems. They can figure out who you are, whether you're using a bank account or a cryptocurrency address. The difference with blockchain, it's easier to catch them. And some of these centralized exchanges that consumers use should start protecting the consumers more. They should start blacklisting these addresses before the crime occurs. So there's great companies out there that are performing the analytics around the money trails, and they know which addresses are suspect. They need to democratize that technology, so to speak. Let the consumers use it themselves so they don't go to bad addresses. The exchanges need to use it before money's hacked out of their account. But the actual infrastructure, it's easier to catch the criminals. And we even saw that with the Mueller report. You know, he was able to catch these hackers from Russia in part because they used Bitcoin, and he could trace the addresses if you look at the report. So when the regulators discuss this, they need to look at the facts, look at the evidence. The evidence is that the money trail is transparent. If you have good analytics, you can see where it's going. The trick is protecting consumers with that information, protecting traders and investors. And that hasn't exactly happened yet.
Yeah, I mean, much of what you're saying is pretty well documented, right? Like, this has been something that people in the crypto industry have been saying for years. As you mentioned, there's many companies that do this for a living. They track blockchain transactions. So why haven't regulators really gotten the memo on this? And why hasn't the mainstream gotten the memo? Because it's still such a popular trope to say that, Bitcoin is a haven for criminals and crypto is the best way for criminals to interact. It seems like this is something that at the government level, people still don't really understand. They still see Bitcoin as this like dark, shadowy network where anything can happen.
Yeah, I know. Even my friends, lots of people think that. And if you look at the volume of illegitimate transactions, I think a recent report said it's 0.15% are not legitimate. I would think the reason the regulators and the general public still think Bitcoin's a haven for criminals is just there's nobody marketing Bitcoin. There's no PR agency because it's a decentralized system. Same with all the DeFi protocols and Ethereum. There's no one out there educating the public and educating Congress. So you end up with all these distortions. In fact, the Russian government used this distorted argument to try and ban crypto, which they're doing in their country by saying this is just a haven for criminals. So it's a little bit like the energy consumption and the understanding that it's really just proof of work, not proof of stake. The miners don't have a PR agency. The validators don't have a PR agency. So we need more education in the market so people understand the truth and the facts.
So Avivah, getting back to what the criminals are doing, what are they doing wrong? What's the one thing that criminals get wrong about crypto? Asking for a friend.
I think when they go after these big hacks like DeFi protocols, what we saw with Badger DAO, for example, and this is well talked about, they steal too much money and they become a target. So if they're taking $500 million out of the system, they're going to have everyone all over them following them and investigating, and they can't get the money out of the system. So they're very greedy, obviously, and when they go after a lot of money, they get the headlights on them. And maybe I think we're starting to see a shift towards smaller hacks. I'm not sure. I don't have the data on it, but something says to me that that's what's happening. So they need to fly under the radar, basically, and that's what they're getting wrong. When they fly over the radar and they commit these big hacks, they get stopped. And you saw that. They gave money back.
So like there is a threshold, you're saying, and what would that number be? Just asking.
That's a good question. Maybe 10 million in US dollar value. I'm not sure. It's the same thing like when you get hacked and you go to the FBI and say, I lost $300,000. They're not going to do anything about it.
If you go over 10 million, you're getting a bit greedy. All right. So do you run the risk of, having blockchain Web3 potentially making us more surveilled than ever before? And if so, is there any way to combat that in terms of getting your privacy back? What do you need to do so that your whole transaction history isn't surveilled?
That's a great question. I mean, the truth is, as long as your address is in the clear, there are things going on behind the scenes that you can't control. Just like when you use your credit card at a point of sale, no matter what you do with your credit card, how well you protect it, you can't protect how it's used in the back end. So frankly, the best thing consumers can do, I think, are use self-hosted wallets. If you start getting into an exchange, then even more information is disclosed. Even the travel rule is going to end up exposing a lot more PII data related to addresses. So when you think about it, most likely consumers are better off using self-hosted wallets, and they have to become a lot easier to use. And they should use multiple addresses, just like they may use multiple bank accounts for their really serious assets. They may want to control it one way. They're going to have to learn how to spread out their assets depending on how much they have. But I've been very disappointed in how some of these centralized exchanges are protecting consumers. There's class action suits going on, and if they didn't use a wallet at that exchange, they'd probably be much better off.